Guys, we have a real treat today. Wizard of Ops, otherwise known as Jason, is going to give us a spiel today about market makers and the options end of our business. And he is a very unusual person that I've met in that he is not only a fund and hedge fund owner and manager, but he also has this interesting service where he gathers data from the trade books directly and massages it in such a way that he can generate Greek data for option traders. He may comment on, maybe towards the end, he might comment on exactly what all that entails. Well, Jason, I'm going to turn you loose.
All right. Melagor, thank you very much for the introduction. My name is Jason Lorenzo. Just to kind of toss it a little bit back, Financial Juice is my go-to site for news. I mean, even more than X or anything else. Anytime I need news, Financial Juice is the place I go. So I am a subscriber as well to Financial Juice. So thank you, Melagor, for having me on, and I also appreciate your service as a news aggregator. So thank you. Yeah, so I was talking to Melagor a little bit, and he was saying how there's always debates in his Discord, in this Discord, about market makers and how they hedge, what they're doing. And I kind of noticed that there's just wandering around. There's a lot of misinformation out there about market makers too. So I thought this would be a good presentation to make, not only to give you an idea of who these market makers are, but also how they hedge, why it's even pertinent to you, and kind of dispel some of the myths. So let's get into it. Yeah, I am an RIA, a registered investment advisor, so I have to show you this disclosure. This is not investment advice, all that kind of stuff. So, all right. So, who are market makers, right? They're also called option wholesalers. They're also called option dealers, right? Who are they? What are they doing? So, when options were kind of issued in CBOE in I think like 1976, 1975, sometime like that. They had middlemen that were facilitating these trades. All right, so like I said, there are a lot of misconceptions about market makers. Who are these people? So when options came out, they were only call options.
I'll take a look here in a second.
And these people, they're kind of middle people that middle men, middle women, mostly men, that are intermediaries between everybody. So really, basically, CBOE has estimated, I think, about 90 to 95% of all option trades go through a market maker. And the reason why is because there's so many different options. It's a little bit different than an equity, where if you have, say, an Apple share and you want to sell it, every share is kind of made the same. It gets traded between a middle person and exchange, but that's pretty cheap to do because it's pretty easy to just find somebody who wants a share. But for options, if you want, say, a 6,800 call for SPX, and somebody else wants to sell a 6,805 call for SPX, that's not a match. Like, you have to have exact matches. Because options have so many different strikes, so many different expirations, so many different underlyings, for all the stocks and everything. Finding, a person that wants your exact trade, think of like every butterfly and vertical that's out there. Finding a person that wants your exact trade without a middleman is very, very difficult. And that's what these option market makers do. They find the whole market, they join people, and if they can't find somebody to join, they take your trade and hedge away the risk. So these people are critical to getting narrow spreads between your bids and asks. They're critical in finding other people to trade and facilitating your thesis, right? So they provide liquidity to the market. They do have some advantages, but their biggest, the fact that they set the price because they are accepting everybody's trades is an advantage that they have. They also have the advantage of seeing the flows before you do. So if they see somebody coming in with large trades, they know how to reprice things, how to distribute their risk before you even know that that trade existed. So when you see something like a large option trade that's out there, they've already seen it, split it up into their risk pieces, all that kind of stuff. So they are not the enemy, right? Um, it's because of them that you have free commissions. Now, market makers, I don't know if you guys have heard of payment for order flow called, PFOF. If you guys have Robinhood or Webull or anything like that, and you have these free commission trades, what you're actually doing, it's not actually free. The market makers kind of auction your order amongst each other, and they pay the exchange. So then you don't have to pay commissions. Um, Easier execution, tighter spreads. That is what the market makers do. These people here on the left, Jane Street, Citadel, they are all examples of market makers. Optiver is actually the first market maker to make 10-cent spreads on SPX. So they're the ones you can thank when you see them. um, so yeah, the market makers are the ones responsible for pricing the options. And if they can't find a one-to-one connection, then um, they accept the other side of your trade and they hedge away the risk, usually with the underlying. So, all right. So if now, whether you're a swing trader or a zero DTE trader, however you trade, because these option market makers typically hedge with the underlying, knowing what they're holding in their book and how to read their book to know how they hedge is vital. Like it's the only way I trade. Like I only trade option dealer flows. And that's what, what Meligor was saying. I have my business called Volin, vol.land. And you could join our Discord, like we have a general page in our Discord, but that is because option volumes have exploded ever since COVID. It went up to like 30 million options a day traded. Now we're up to around 62, 63 for an average day, 62 to 63 million options on an average day. We have multiple times we have hit 100 million options traded in a day, usually in market stress times. So these books have become huge, robust, especially with zero DTE options. So we'll get into now how how retail, how traders look at their books, and also how market makers do. But we'll do a quick introduction on the Greeks. So I don't know how many of you have heard of. Nope, sorry, Mel. I don't know how many of you have heard of what the Greeks are, option Greeks or whatever. They are basically they're derivatives of the option price that tell you how the value of that option will change based on certain things. So options are, as a derivative product, they are inherently a insurance product. Okay, how do you insure your uh, how do you insure your portfolio? Your Apple portfolio or something. You could either diversify or try to do dispersion trades, buy Apple, sell Microsoft, something like that. Or you could just buy a put. Buying a put is essentially term stock insurance, right? Um, so there are several aspects of options. There are several variables. The underlying price versus the strike, really where it is relative to the strike, the time until expiration, and then the implied volatility. So each option is priced for how wild the market has been, or however the market maker decides to price implied volatility. It's kind of like regular insurance, right? If you have car insurance, you are basically, you have a put option on your car, right? So you're driving around your car, you're paying this premium every single month. And if you get into an accident, then your put pays off, right? You get all of a sudden a huge loss, which is why, or a huge gain on your put option, right? Um, that's why, when people just sell options, I'm always kind of iffy on doing that because maybe prices are a little cheap on options, right? So that's why, that's kind of how options work. These are the variables. So we'll go through kind of the main Greeks, the first order Greeks, and how you look at them as a trader, and then how the market maker looks at them and how they hedge these. Okay, because these Greeks represent the risk that the market makers are holding, right? So next slide. Okay, so delta is the change in the value of the option, so it's P&L versus movements in the underlying price. Okay, so it's directional risk. If you own a put and the price goes against you, it loses at the pace of delta. Okay, if it goes with you, it gains at the pace of delta, right? In the retail mind, delta is how you make money, right? Oh, I think prices, I think the jobs report is going to be terrible. I'm buying a put, right? I think the market will go down after jobs. I'm buying a put. Um, so that's, most trading on the retail platforms and stuff, that's how it's done. Um, Delta also gives you a general distribution of how market makers are seeing the market pricing itself out. So, there's delta goes from, zero point 0.1, which is a 10% chance, to 0.5, which is the most likely based on history, usually, the most likely price that it will end at that expiration. And then, zero point 0.9, which is, that it's really kind of like a 0.1 in the other way. It's an even distribution, right? And that's, when you look at deltas in Thinkorswim or, kind of your platform, and you look at the option chain and you look at the deltas, you're like, oh, dealers are expecting the market to close at 68.15 at the end of the day. At least that's last when I saw it. That was today's expected close. I know you guys have your closing bets, right? You guys do you guys do your closing bets every day. I debated getting involved in that, but I figured I'd be cheating. So, um, um, anyway, now one thing that a lot of people get confused is market makers. People think that market makers are manipulating the market based on their book. So they think that, oh, the market makers have a lot of puts, therefore the market will sell off so that market makers can make money. That is not the case at all. They are constantly delta hedging. Okay. By the end of every single day, they need to hedge all their deltas. Otherwise, they get fired. So they can't have a directional bias, right? And when I'm looking at this, the retail edge is adverse selection. You're allowed to have an opinion. The market maker is not. Okay. Or, the wholesaler. Yes, sometimes market makers do kind of, lean one way or the other intraday. But by the end of the day, they have to be delta neutral. There's also their clearinghouse is enforcing that too because they don't want to get the rug pulled and then all of a sudden the clearinghouse is responsible for millions of dollars of outlays, right? So that is why even if the market maker made a ton of money that day and they are not delta neutral, they will get fired, right? Usually they get one strike and then they're out. So retail investors, kind of the way they typically act is, I think the market's going to go up or down, and they just buy a put, buy a call, something like that. Sometimes there are volatility sellers. They just don't like theta, or they don't like market not moving and not making them money. So, I mean, but that's typically retail investors look at direction more than anything else. All right. Go ahead, Joe. All right. So, from the market maker perspective, what is the market maker doing in order to hedge their deltas, right? First of all, delta and direction is the quickest way for the market maker to lose money. I mean, you think about it, if you have an opinion on something and you know it's somewhat informed, the market maker is taking the other side of everybody's opinions, right? And you know, in general, that's not the place to be, right? If you know, last year the Chiefs and the Eagles were in the Super Bowl, and if everybody's betting on the Eagles, you know, the market, you know, your bookie, who is kind of your market maker, they have to change the line or something. They have to try to even out the risk, right? They don't want something that will make them bankrupt immediately, right? And if everybody's opinion is being shared and it's all one-sided, they cannot, you know, they don't want to lose money like that. All right. However, the good news for the market maker is it's the easiest to hedge. If you are holding a zero point 0.5 delta Apple put or you know Apple call, you have 0.5 deltas. That means for every $1 that Apple moves, your option will move up 50 cents, right? So what do? Options are typically 100 share or worth 100 shares, so they sell 50. Now they're delta neutral, right? They're short 50 shares, they're long that 50 delta call, right? And that's if somebody else sells that call. So when they price these deltas, right? The delta is meant to reflect the distribution of historical returns. Now, right there, that's where you should start getting your you know your brain thinking. It is historical returns necessarily going to reflect future returns, right? And it's that difference, that opinion that you can have that will give you an edge over market makers, right? Um, and again, I mean, you know, that's kind of what Volland is showing. Like it shows you what the dealers are holding and how they have to hedge. So that's, you know, it's vital information, at least, you know, again for me, but that's how I trade. So um so the market maker is a liquidity provider, right? That makes you retail a liquidity taker, okay? And their strategy is basically provide liquidity, slightly overprice the options based on historical returns. This is called variance risk premium. I don't know if you ever heard of that, but and then they hedge with the underlying. If there is a huge order, right? They market makers typically kind of band up and split it, right? You know, and they help each other out a little bit. Um, it just kind of takes risk off their books, and they also closely monitor whose trade that is. So that's another advantage that market makers have over us is when an order comes in, they know who it is. They don't care if it's you know Meligor or even they don't even care if it's Trade Journal. They care if it's Goldman Sachs, right? Every market maker I talk to says Goldman Sachs gets a little premium added to their order. But people like us, I mean, they love our, you know, we're quote unquote uninformed traders. So they are more likely to give us better prices, right? Anybody on a retail platform, we're able to get better prices. Um, so yeah, and all platforms have to identify you as either retail or institutional. So institutional, you get a little bit worse prices. It's kind of not what most retail thinks. Most retail thinks everybody's in bed with each other, but that's actually not the case. So okay, move on, Joe. All right, so gamma. I kind of call gamma, you know, from the retail perspective, it's that magical fairy dust that issues your crazy gains, right? I don't know. A lot of you probably have gone on X or TikTok and you see some guy who's you know, dancing on his yacht with like four girls and he's like, "Oh, I'm making tons of money right now because, you know, the way that it's even possible is gamma." Now, granted, that guy in the yacht's probably lying to you, but highly likely lying to you. But um, but gamma is the way that you take your $1 option and turn it into $10, and all of a sudden, whoa, you know, you know, you just made 10x on your trade. Um, that from the retail perspective, I mean, you guys love that, right? Most people who trade options, that's their thing. Gamma is largest in the middle at that delta zero point 0.5. and it starts to decrease. It's also larger the closer you are to expiration. So if you have that tight pricing, there's not a lot of time left for anything weird to happen. They will price it, market makers tend to price it a little tighter so that because they're competing against each other for your flow. Um, so gamma can get larger the closer you get to expiration, which usually means zero DTE people, um, you know, right at that like 2 o'clock time frame, that 1 to 3 time frame, start buying options. Don't sell options. Start buying options. As long as the implied volatility is pretty low relatively. And right now it kind of is, but especially at like starting at like 3 o'clock, it's like 5 points away for, a buck. You can probably make some money. So, again, the retail edge is adverse selection. Um, and the price for your gamma is the premium of the option. Like because gamma is, it's magical fairy dust for you. Joe, you can go on to the next one. It is the greatest fear for the market maker. Okay. Um, it's their primary risk, right? And they don't want to lose that. It's kind of, again, if I go back to car insurance, it's kind of like, the biggest fear that your insurance company has is you getting into a crash because then the next thing they have to pay 30 grand while you're only paying them $100 that month, right? Now, so they try to price it so that all the $100 kind of adds up um, to more than the 30 grand when you crash. And that's also why, if the market hasn't moved a lot recently, they will price it a little tighter, right? Because the market hasn't moved, you haven't gotten into a crash recently, same kind of thing, right? But as soon as you get into a crash or the market gets into a crash, they will price it very wide. They demand edge. The prices go higher. And, that's when you see VIX shooting up, right? That's what VIX is. It's that implied volatility. But because the market makers have to make money, they have to give you a price, right? So they overprice the options based on historical returns, and they overhedge when gamma is too high. So let's say there's a sell-off coming, and they are positioned to lose a lot of money on puts, so they will overhedge when it gets too close to them losing money, right? They're usually collecting premiums, so if their premiums get wiped out based on a market move, they overhedge to make sure that they retain their premiums. Large hedging orders or leaps that usually have like a low delta or something, or gamma, that can be managed through like other orders as well. So, like a lot of people. I don't know if you guys do leaps. If you're doing swing trading, you're probably not doing leaps, but those are the market makers love those because they don't have a ton of gamma. They're way far out and way far out of the money. So if you want to be a market maker's friend, buy some leaps and tell them who you are. So so that's kind of how they see gamma. But anyway, now is the market maker advantage, Jill, if you want to click the next one. So kind of again, I'm going to go to car insurance. Car insurance, you have to pay a premium, right? You're not going to, it's usually a little bit more than what the car insurance, what your payouts and stuff like that would be. The premium on an option is measured by premium Greeks, typically vega and theta. Vega is the sensitivity of your option to changes in implied volatility. So if the market starts, swinging a little wilder, your Vegas are going to expand. Implied volatility is going to expand, and if you're positive Vega, you're going to make money on that. If you own the option, then that's how you're going to make. You are going to make money. If you're a seller of the option, you're going to lose money, right? In the retail mind, Vega and theta, by the way, is time sensitivity. So as time gets closer, your option decays quicker in an exponential fashion, right? Um, if you have 5 days left till expiration, 1 day passing is worth more than if you have 500 days left till expiration. So theta is an exponential constant that as time decays, your option value decays. In the retail mind, Vega and Theta are typically a buzzkill, right? Um, it's overshadowed by the directional Greeks because really your edge, again, is an opinion, right? You can have an opinion while the market maker can't. The market maker is making you pay for your opinion in Vega and Theta, okay? Theta and Gamma will always have the opposite sign, all right? Um, Again, retail edge though is liquidity control. Like let's say you can buy or sell 5 or 10. Like let's say you look at puts and you're like, oh, I think puts are cheap. You're going to buy 5 instead of 1. The market maker can't make that decision for you. You can make that decision, right? Kind of like gamma, Vega and Theta is the largest at the zero point 0.5 delta and starts to decrease the further you get from that. Vega gets larger as the more days till expiration you have. Again, if you kind of think of it this way, I can ask you what you're going to have for dinner tonight, and you'll probably have some sort of answer. But if I ask you, what are you going to have for dinner a year and a half from now, you're going to have no idea. Maybe you'll, want pasta. Who knows? But that is the idea. There's more that can happen in a year and a half from now than one day. So when you are day trading, you don't have to deal with Vega as much, but you do have to deal with Theta because that's how much time is left. Like I said, it's an exponential constant. So theta decay is your primary thing to think about. Okay. Um, Theta, because I said before how market makers tend to overprice just a little bit, they tend to overprice the option. Premium sellers are kind of born from hating that overpricedness, right? There are, I think, at like Tasty Trade, and I'm sure you guys have heard a lot of others, the income trading, where people constantly are trying to do the same trade every month or every week or something like that, like a butterfly, always theta positive. Um, and they're trying, those that class of option trader is born from this decay, right? From a market maker standpoint, they actually here, Joe, if you want to go to the next slide. Market makers actually Vega contributes to their edge, right? Um, so they don't hedge it actually very religiously. They hedge their deltas and gammas because again, direction is the primary way they lose money. But Vega and Theta, that's that little overpricing. So they actually make money on Vega and Theta. So they don't hedge it very much. Um, and that kind of this, in our we do a lot of studies, and I, as Meligor said, I am a CIO in a hedge fund, um, and we do a lot of statistical studies on these dealer trends, and it turns out that Vega is the one kind of Greek that dealers are susceptible to, all right? Because they're trying to squeeze as much money as they can out of just natural decay of that option price. And that's kind of why they overprice it a little bit. Um, so they try to squeeze that little bit all the time. And they and that makes them kind of susceptible to implied volatility changes. Again, I'll talk a little bit about Voland. I mean, it's why I built it because I knew these dynamics existed, and I thought it would be good to bring um, institutional level data to retail. It's good to do that. Retail is a very robust market, so when we look at this, we kind of look at Vanna because deltas. Vanna is Vega converted into deltas, right? And we look at that and we see dealers are going to have to hedge a lot more positively. They're going to have to buy a lot here. They're going to have to sell a lot here. Um, and we do that measuring, using these various Greeks and can anticipate using mainly Vega and Theta and premium Greeks can anticipate the next move that the market makers have to make, both on a zero DTE and a swing basis. Um, and that's what we do. Yeah. So like Gamma, though, what market makers really want is liquidity. Every order they get, they're getting a little bit more edge, right? So they want as many orders as possible. If there's too much one-sided trading, so if everybody is buying options, right, that can catch the market makers off guard a little bit since they price their things based on historical distributions, not as much on their own position. So they don't take as much, they don't take their book as much into account as, honestly, for me, and my hedge fund kind of proves it out. They don't take their own positioning as much into account as they should when they're pricing their options, right? Um, their own position is only taken into account as an adjustment to implied volatility, and it tries to kind of predict current liquidity with historical liquidity, and that's like I said, that's kind of the opportunity that dealer positioning gives. A couple of little side notes to talk about before move on and go to like questions or whatever. I'm sure a lot of you have seen or talked about skew. Skew is the altering of implied volatility along the option chain. So, the implied volatility gets larger the further away you are from the money. This is to account for gamma. If you have a 50-cent option that's way out of the money, that's going to increase in multiples a lot quicker. In 1987, I'm sure some of you have heard of, the market crash in 1987. That was caused because the dealers did not have skew on their books. And so every implied volatility was the same. They were all using Black-Scholes. Every implied volatility was the same. And when the market started to crash, the market makers made it way worse because they didn't account for gamma in their pricing, and they got wiped out. And that's what was it? The insurance, what's that company called? Yeah, that portfolio insurance company. I forget what it's called. It's kind of in the tip of my mind, but they were kind of one of the main culprits of this, and they got wiped out completely in that one day. When you saw, so when skew is underpriced, that's when you can see something like when markets come down and skew, and VIX blows up, right? VIX like goes up 10 points and the market came down 2%. That's because the dealers have underpriced skew. And that's another thing that we measure in Volin very heavily, because that's really where, when you see some stress points in the market maker book, that's when you can actually, that's when you could seriously make some money. So yeah, and so that's kind of where so Jill, I guess the next slide I think is, so all this stuff, I mean, this is it's probably a lot of really good information, and I'm hitting you guys a little bit with a fire hose. Just wanted to plug a little bit, I guess. We have, if you go to vol.land, that's our data dashboard. We also have an academy that's complimentary. It's there to teach you all about all that kind of stuff. And we also have our Volin Discord. You just go to volindiscord.com. It's our kind of permanent invite. And I also have my YouTube at Wizard of Ops. I have a show every Monday, talk about what the options look like for this week. And I also do a Tradier show every Thursday as well. Another thing I did want to mention, I didn't put a slide in here, but I did want to caution everybody about a lot of retail platforms have quote unquote dealer positioning. And, one of the reasons why I started Volland was because a lot of that dealer position, I'm an economist by trade. I have a master's in economics. Did a lot of econometrics in my life and a lot of data analysis in my life. I used to do data analysis for the government, right? For like 15 years, I did that. Um, a lot of that data is very reductive. So, I'm sure a lot of you have heard about JEX and gamma exposure. That is a a very, that's people who assume that every put has been bought by customers and every call has been sold. And anybody here who has been bullish and bought a call knows that not every call is sold. Um, and in fact, actually recently, we're seeing the complete opposite. We're seeing more puts being sold and more calls being bought. Um, which is, by the way, it's mostly hedging positions. So that doesn't mean that customers are bullish. They are actually bearish because they're selling off their positions and giving up their insurance. So that is, this is the kind of stuff that it kind of bugs me, and it's why we started Volland. You don't want to get involved in bad data because then you're going to end up making bad moves. I mean, that's it's the fact of the matter. At Volland, what we do is we go down to the trade level. Every single trade is processed through the it's called OPRA, the Option Pricing Regulatory Authority, and every single trade is made public as it happens. We ingest all of that, categorize individually, and then calculate the Greeks in real time. Our Volland dashboard updates every 2 minutes. So you zero DTE traders out there, you want to see how number one, how customer flows are happening, and number two, how dealer flows will happen. I don't know how you trade zero DTE without it. Um, so yeah, I mean, of there's a lot of data out there through this information that I think would benefit everybody's trading, and it would make Meligore would even make you a better trader than Trade Journal. So I think.
I'm not sure about that.
uh, we'll see. We'll see. But anyway, so yeah, I'm happy now. I got like a nice 20 minutes. I'm sure that you guys might have quite a few questions um, to talk about. Yeah, let me go to the chat. All right. Oh, freelancepreneur. You get. Oh, is this okay? So is that noon? Is that me? Yeah. Okay. Primarily. Okay. Yeah. Here we go. All right. Freelancepreneur. I was curious about your input was on if markets were to introduce 24/7 trading, which is rumored to happen, or at least extended after hours trading, how that might affect the stock market. So, um, do I think it'll be crazy volatility like BTC? So here's a secret, freelancepreneur. We pretty much already have 24/7 trading. SPX options are traded in Europe and in Asia. Asia doesn't really have that many market makers, but London has more market makers than most U.S. I don't know about Chicago and Miami, but they have more market makers, option market makers, than probably like New York. Um, London is huge in that. In Greece, they have huge um, American trading hedge funds that trade strictly on vol. Um, Even Johannes's home country of Germany and Spain have been ramping up their American trading. And the reason why America is such a it's such an attractive equity market for Europeans, especially, is because in Europe, the EU has a single monetary policy kind of structure, the ECB, but each country has their own stock market, their own market, and they all have different rules. And yeah, I'm sure it feels are good over there, and for Johannes at European time. But they all have their own regulations, and they're all different, and um, it's difficult to coordinate. Like what do I have for German, for a DAX option versus with EU restrictions and monetary policy being centralized. It's difficult over there. I met somebody from Susquehanna not long ago where he was saying that people in Europe, vol traders in Europe always go to American options because it's the most liquid, and and it's also the most consistent as far as laws go and banking goes. Um, so do I think that 24/7 trading will affect the stock market? I think it will affect the stock. If anything, it will make it less volatile, not more volatile, because it will just increase liquidity. So, uh, all right. Other question two: what common misconceptions do traders have about market makers and price manipulation? So, market makers do not manipulate prices. It's not their goal to make their options make as much money as possible. What they are trying to do is, what they're trying to do is gain as much flow, which neutralizes their risk. The more flow they have, the less risk they have because they're catching edge every single time. Um, so they're trying to get as much flow as possible. They don't manipulate options necessarily. They just try to price options. They're like in competition with each other. So they're not trying to screw you. They're trying to get the better price than their next door neighbor, right? Jane Street and Optiver are in competition with each other. Sometimes they can help each other out a little bit if there's a big order and they're like splitting it up between each other, and that happens. But most of the time, market makers are just, they're fighting each other, right? Um, so you guys are benefiting more than anything from market makers. They're not trying to spike you. You are their best customers. And the other thing too is exchanges. I at SIBO, they cater to their market makers so much because the market makers are the exchange's best friend, and retail in particular is the market maker's best friend. So you guys help them, and they're not trying. I know that there's a concept out there, the max pain concept. Um, and they're trying, like, as if market makers are trying to induce as much pain on people as possible. That's not the case at all. They're just basically what they try to do with their book is the min pain concept, which is they want to minimize pain for themselves, which does not mean maximize pain for you. Um, they're just trying to hedge away all of their risk, and yes, sometimes market makers lose money. Um, they do, they're not perfect by any means, and if your opinion is right, you can end up making money on that. So, do I think that market makers like brokers like Robinhood and Webull oh yeah, market makers love brokers like Robinhood and Webull because um though Robinhood as a broker gamifies trading. If the trading is a game, that means market makers are getting more uninformed money into their pockets, which is why companies like Robinhood and Webull do a lot of payment for order flow. You guys have free commissions on Robinhood, right? The payment for order flow. So the Robinhood puts up your order and they say, okay, give me your best bid, and off of the exchange, Citadel and Susquehanna and Optiver. They're like, I'll pay you 5 cents for it. I'll pay you 4 cents for it. Whatever. And they just, okay, sold, and they give it usually to Citadel. Citadel usually bids the lowest. Um, but things like Robinhood, those brokers, their goal is to make you think you're playing a game, not investing your money. And market makers love that. So they will give a better price even to people like Robinhood and Webull because they know that, well, the average trader on those platforms is quote unquote like a dumb trader. So, um, when retail kind of thing. Why do me as a market maker prefer options would be, oh, I'm not a market maker. I mean, I am a hedge fund, so I am taking advantage of market makers. I'm not a market maker. I prefer options because I like to trade on delta, gamma, and vega. I don't, you can't trade implied volatility with an equity, right? With a stock. Um, so that's, I talked to a lot of market makers. I'm friends with a few, especially as market makers get replaced by computers. There's a lot of former market makers out there trying to make a buck because, their job was taken by a computer. So, I make friends with them, and they tell me some juicy secrets. So, all right. Do I feel option flow programs give a realistic level for gamma Jex levels, or by the time retail might be seeing it, it might be a bit too late to act on it? Okay. So what I was talking about before about Vega and Theta, um, they don't. The market maker does not hedge that immediately, right? These Vega Theta, and you need to know the premium of the option. There's a lot of these Jex that again, just assume puts are bought and all calls are sold, or they have other little assumptions, OI movements and stuff like that. There's even a product out there that's given out by CBOE called open close data, which gives you every 10 minutes, it gives you the position, like what market makers have. Problem is that you need it to be trade level because this Vega and Theta is where you can make money on them because they don't hedge this. They hedge, like 10 to 20% of their Vega most of the time. So knowing their Vega position is what you need, and you need it at a granular trade level because you need to know how much current edge the dealers have. They, if you think about it, I just told you market makers are CBOE's best customers. Do you think it's CBOE is going to be willing to, throw the market makers under the bus by releasing their positioning that gives away what they want? Um, we have explored, at Volland, even before we launched, we've explored the best possible way to do these things, and really, the only way to get good granular Greek data is at the trade level. So I a lot of these, I'm not going to start mentioning competing services, but a lot of, and I put that in quotes because our data is by far the most robust. And, a lot of our widgets and stuff on Volland are born from that. And you get real actual data, not just, flashy wrong data versus, um, I guess, real data, like accurate data. So, um, but no, I don't think it's too late to act on it because, again, like I said, dealers don't necessarily hedge some of these positions, so you can take advantage of it when you see that. Um, it's not. Usually, I find myself too early. That's my hardest thing. So, last question would be: how do market makers react to live news seen on Financial Juice? Is there certain things that they do change to hedge? Honestly, no, they don't. And that's kind of why I'm saying like you have an advantage. There are algorithms that, like news algorithms. I don't know, Meligor, you can tell me if people hook into Financial Juice into an API or something. But as things are released, there are news algorithms um, that will like if today's jobs data was what it was, it was like minus 100,000 last month and plus 60 something thousand this month. um they will have kind of areas that they will initially buy or sell. I don't know why these news algorithms exist. I think like they've got to be losing money. Like today, as soon as that data came out, there was like a huge buy, and now we're down 70 points. It seems like that initial push is such a dice roll. I, I don't I don't get it why they exist, but those news algos do change price, so that does change the market makers hedging formula, right? If there is a news event coming, they know the news event is coming, they will change their pricing, right? If you think about it, again, I'll do insurance again. If you have car insurance and there's a hurricane coming and you're trying to buy new car insurance, they're going to charge you more, right? They're like, there's a hurricane coming, it's going to damage your car. Um, but if you have a clean driving record, you buy car insurance, you're going to get a lower price. Then if you crash, then it's that's a problem um, for them, for the market maker, for the insurance provider. So I don't know if they hook into financial juice at an API basis, but there are news algos out there that change the price, and the price change from that will affect the market makers. But they see that flow. Remember, they see that flow from before you do, so they can adjust probably quicker than you can. So let's see. Johannes is laughing. All right, 3D God. Oh, we got some. All right, I got to make sure my answers are shorter because I've now got 4 questions. I may have missed the start, but I liked how you described Vanna as Vega in Delta form. What would you describe Charm? Charm is Theta in Delta terms, right? Um, and back again, we have Charm charts and stuff like that in our in Volund for 0 DTE traders. Charm tends to be the more because time is just ticking away. Charm tends to be more of a driver than you know gamma or anything else in the 0 DTE time frame. Um, so yeah, that's what Charm is. Charm is uh, theta in delta terms. Also, quad witching and a few other similar events I used to hear about all the time. Are these things still relevant? Yes, they absolutely are. Is there one that happened recently that you can talk about? As far as quad witching, I mean, last month, last month in November, we had a sell off right around expiration. The biggest example is, when did the market sell off for COVID? Um, COVID sold off the Monday. I know, like, everything shut down and stuff like that, but it shut down the Monday after expiration, and that is not a mistake. You know, tons of bullish positions cleared off the books on OPEX in March. That's quad witching. Um, when that happened, it opened the door for sellers to come in and sell their COVID uh, bets, right? That's if people get scared, they say like total premiums traded for a quad witching. That's not necessarily, you kind of have to know the net position. Again, I keep peddling my own product here. I feel, but that's what Volun does. It gives you, it tells you if you should be scared for quad witching or not. I honestly, for December, I have been concerned. I don't know how many of you follow me on Substack, another, a free daily Substack I give out, but you can sign up for it. But I kind of give like my SPX kind of overlook for the day. And for a couple weeks now, even though we've been going up, I was like, a test of 6,700s probably that might happen, right? I haven't been looking at markets for the past hour, but here we are. Now we're creeping close to 6,700. So that kind of stuff, when you see the options and you kind of learn how to read the market makers book, it becomes, especially for swing or day trading, like those, 1 year trading, it's not as helpful, but for swing and day trading, it's very helpful to see how market makers are going to affect flow. So, and quad witching is usually very large changes in market maker positioning. So, um, you assumed from the lack of information about it behind the scenes, I wasn't getting all the info similar to Jack's thing I spoke about. I don't quite know what that means, but I mean, our information and our data is way more valuable than Jack's data. So, Roger, who's in my server, the white paper says that spot vol correlation is possibly driven by dealer Vega hedging. That is true. Does that mean they're dynamically hedging their Vega as vol moves? No, they price it assuming that Vega is their book Vega is going to move as price moves. So it's more based on how they price the options. Not so much they're not dynamically hedging Vega. That's the way they price it. And as vol moves, all the other implied volatilities on all the other options are changing. Skew is changing. Things so they're not hedging Vega, they're changing prices. So, which I guess you could say is hedging Vega, but yeah. Yeah, no problem, freelance. Yeah. A, B, C, D, E, F, G. Very happy you know your alphabet. Using Volun data, were we able to understand the COVID market sell-off before it happened? Yes, but you know what? I'm going to give you a better example. This most recent um, the tariff environment, we saw that both customers and market makers were not accounting for the tariff thing all that much, right? We saw with the premiums were small, and we saw that there was no puts being bought during that time. They weren't being sold either, but they weren't being bought. So yeah, I don't, COVID actually, Volin wasn't publicly available during COVID. So the tariffs time frame, not only did we see the possible drop, but once those tariffs were announced and everybody bought puts, we saw the possibility of a rapid recovery. And then when Trump called off the tariffs, I was not expecting it. What was it, like a 10% day? I was expecting though, like something like 4 or 5%. So I mean, I was selling. Um, I had longs on during the COVID or during the tariff sell off. I started positioning myself for a rebound because we were deep into um, our Vanna positioning and our Gamma positioning was showing that if somebody started buying, it would rocket. It would shoot up. Again, did not expect 10% or whatever that was. I forget how much that was that day, but it was a lot, and was not expecting it that much. Um, but we had positions that were way out of the money. Made some decent money on that, and you can like I said, there's this academy. Join the Discord. There's a lot of people in there that'll help, including Johannes. There's a lot of people in there that will help guide you and show you what the market maker book is implying. So, all right, I guess I could look here, Jill. If you want to unshare your screen, or I don't. What's the next slide? Next slide was just a thank you, right? Okay.
Yep, that's correct. It was just a thank you.
All right. So I'll just tell you guys, thank you. Cool. Anybody else have any questions? You want to talk about anything, or?
That was awesome, Jason. I really appreciate it. Very, very instructive.
Milligore, my pleasure. Again, I'll give myself a little bit of a plug. I told you I own 3 businesses, so I'll give you a rundown. Vol.land. I think everybody in here is pretty much DIY traders and investors. Vol.land is where you can get a good view of the market maker book. And you can join the Vol in Discord. It's that one. We have sub pages, but we also have a general page. If you want to just come in and ask questions, people are there to help. Just go to volindiscord.com. I'm also a registered investment advisor. That's for people who want to invest their long-term funds. I have some Volund and a Volund fund, and then some structured products that can help. And then if you're an accredited investor, we have a Kyrios hedge fund. It's been active for about a year and 3 months, I guess now. And so over the past, after our forward testing, we've only lost money 1 month. So, yeah, we've been doing well. There's no other dealer positioning out there that has a validation like a full legal audited hedge fund. So, Cool. So thank you very much, everybody. Thanks for listening. I hope you have I wish everybody, I'm also in this Discord, so if you want to ask me a quick question, you can tag me in something. I'll eventually get to it. So thank you, Belagor, for having me too. And thank you for your service. Your service is fantastic. I enjoy Financial Juice very much.
I'm glad you do.
So take care, everybody.
Good trading, everybody.
Yep. Thank you.